Hello, can you hear me?
Yes, Avkash, very much.
Yes. Thank you, thank you. So we are good. So good morning, one and all. Thank you, ladies and gentlemen. Very warm welcome here for this webinar on investment and wealth management. Our CA Swadaji couldn't join us today because of circumstances, but we have a very engaging and insightful session with our financial advisor, Rishabh Sir here. So I'll just give a short intro about Rishabh. He's a seasoned financial advisor with great experience, empowering, high net worth individuals, CXOs, and businessmen to find their prosperity, maximizing profits, and minimizing their losses. The last 20 minutes will be dedicated for question and answer session and giving us opportunity to have direct insightful session with the. Without further adding, and let us sit back and relax, and the Rishabh starts his here. Thank you. Over to you, sir.
Thank you, Avkash. And a very good morning to all the participants who have taken time out on a Saturday morning to join for this session on wealth management. I'm sure we are all very excited to be in the today's session where we will discuss some of the finer aspects of personal finance. And the reason why we say personal finance, wealth management, is that finance is a subject which is very personal to each one. And generally, one thumb rule will not really apply to all the participants, right? So that's the reason it's called personal finance. And that's what we will discuss more about today in detail as to what really happens as far as wealth management is concerned and how we could better do with it. Avkash, my screen is visible, right? The PPT?
Yes, perfectly.
I'll just do it on the full mode.
Yeah, I can full screen.
So, to set the context right, there's a American billionaire who was one of the first billionaires in the world, Sir John Rockefeller, and he was once asked how much money is enough money, and he gave a very interesting reply: just a little bit more. The same thing happens, with our savings, our wealth, that we may have some kind of savings with us, but we need a little more money just to ensure that we have a better lifestyle than what we do currently. So that can be definitely achieved by one if the planning is done well, and we can certainly get a little bit more than what we already have. The human mind, has a great ability to adapt to situations, things that we come across. And, in the recent past, we have had enough experiences of our life where we have seen things like COVID, where it has become a thing of a past. And now we are all forgotten about those days and events and move forward into a new life where we are interacting from physical webinars, seminars. We have come to virtual seminars, and so the same thing applies as far as personal finance is concerned. So if we have the right direction as far as our personal finances are concerned, we can certainly do much better with our finances. And it is very, very simple. It is our human mind that we complicate by doing things which may not really be necessary. So I think if we can simplify to the extent possible, sky is the limit as far as making wealth is concerned. We've all seen or heard about this famous KBC, Kaun Banega Crorepati. And each one of us, if already a crorepati, we want to be arabpati and more, right? But the most interesting part, and we would have heard about one of those contestants, Sushil Kumar, who had won 5 crores when he had participated in the KBC, and he did not have a very good background. It is very, very interesting to note that within a very less than 1-2 years of time span, uh, he became bankrupt. So in spite of earning a very handsome money which is beyond his imagination, he could not manage his savings in the way it was required to be managed, and because of which he lost and became bankrupt, uh, in spite of having a reasonable savings. So it is very important that we all save money, save and utilize that money to the best possible use, because it's all hard-earned money which each one of us gets. And if that hard-earned money is not put to right use, then I think we are doing an injustice not only of earning but of our overall savings. And we have a lot of examples of various industrialists who've earned a reasonable money, scaled to new heights, and because of their mismanagement, because of various instances, they came under a debt trap and ultimately became bankrupt. They had to sell their assets, etc. So it's very, very important and crucial that we manage our savings very well. So the agenda for today, we will be covering these topics. We'll give you an overview and insight as to what is wealth management, some perspective around equity markets uh, at various levels, the concerns, especially with the election around, what are the sentiments going on, why we should have an insurance plan in place, whether we have an adequate insurance, because most people have insurance, but whether it's right, some of the key rules or thumb rules for investing, which one can keep in mind, and we can follow it with Q&A. So what really is wealth? These are some of the asset classes and options that are typically available to an investor, right? We all do savings, and among all these investment options that you can see on screen. But the idea for us of wealth is that, of course, it is a combined saving of all these things. At what rate are we growing this wealth? That's very, very critical. So we may have a bank fixed deposit, we may have real estate, gold, equity, mutual funds, but on a combined basis, at what rate are we growing these assets? That's very, very critical, that we need to understand. Because we know that, say, typically a bank fixed deposit or a PPF would give stable returns. It has a fixed maturity date. It is liquid in nature. So that's one of the perspective. So it gives around 7-8%. That's fair enough. The second most popular choice among Indians is, of course, real estate, and people typically like to have more than one house, which can give them rental yields and a sense of security that in case something goes bad, they can always back up on that. But of course, it comes with its own set of limitations. We have seen that in the last 10 years, real estate market is really seen a slack and not much appreciation. The third common choice of most people is, of course, gold. And directly or indirectly, we have a large chunk of savings in every household in the form of jewelry. So that is the third option. Equity is something which is still very nascent as far as India is concerned. There is a long way to go because the rate of participation in equity in Indian markets is still very, very low, because of the risk concern, because of the past incidences, etc. And of course, mutual funds is gaining popularity due to a lot of advertisements, awareness, and a large chunk of money is currently being managed of investors through mutual funds. So these are the options largely available to investors. So what do we typically expect from your investments, right? In our opinion, expecting a reasonable return of around 12 to 15%, which beats inflation, I think is a very, very reasonable expectation which one should have. as far as their overall portfolio is concerned. When I said overall portfolio, I mean the bank fixed deposit, real estate, equity, all put together should generate this number, because typically an HNI inflation is of around 10%. So we need to manage our savings overall balance sheet at a rate which is growing beyond 10%. And in our opinion, if you're able to reduce the risk and earn a consistent 12 to 15%, one is doing a very good job. Second is that you need a predictability. Like I said, if you have consistency of returns, even when markets are volatile, if you can ease out or smoothen the curve, then I think one is doing the job. The third is liquidity, because like we saw in case of say real estate, PPF, these options generally are not liquid in nature. I'm not saying those are bad options, but one can really think that what are the options where you can get full liquidity in case of needs. And the fourth is the negligible risk of capital, because nobody wants to see that if they have invested 100, that 100 is becoming 80, right? We will not be able to digest that fact that the 100 should not go to 80. So if we can reduce, I'm not saying that we can 100% erode that risk possibility, but if we can reduce that risk to almost negligible, then I think we are doing the job well. So inflation, typically announced by the government is of around 7%. So the government publishes data and they point out that consumer inflation is around 6-7%. But the actual inflation, as per institutional research, is of around 12%. So what we are saying is that the number announced by the government is not wrong, but it is not true for you and me. The reason why it is not true for you and me is that when government is saying, say, a 7% inflation, they are assuming that 50% of your income is towards food items, basic consumables, which is true for a large population of India, but it is not true for you and me. For us, suppose if we are earning a lakh of rupees a month, we don't spend 50,000 towards food items, basic consumables. Our most of the expenses go towards the lifestyle, right? Maybe a weekend spend to a restaurant, to a mall, do some kind of outing. So those are the expenses where our major chunk of earnings go into. And those expenses typically are growing in the range of 10 to 12% as per the institutional research. And that's the reason you need to grow your overall savings at a rate which is beating this. And how does this 12% come, right? The inflation number that we are talking of. So this is where the inflation number comes into picture. So if you look at that, the actual data for various expenses, if we talk of airfare, the banquet cost, gold, US education, the property in India, and the membership. So these are the expenses which have actually grown at this various rate. And if you look at the average, it comes to around 12%. So that's where the actual expenses are growing at this rate. And we are not even talking of lifestyle upgrade. So today, if you are going overseas and we generally say maybe traveling in an economy by flight, we want to upgrade our lifestyle to a business class, right? Or if we were planning to go on a holiday, maybe to a location within India, one wants to go to a location overseas. So these are the lifestyle upgrades that we are talking of, which we also need to factor in. And that's where there is all the more need that we grow our savings at a rate which is reasonably beating inflation. Yeah. So,
Rishabh,
if we,
Rishabh,
yeah. Sorry,
once again, can you please move the slides? People are asking to move the slides.
sorry.
Can you please move the slides? Lights?
Yeah. Now it's visible, right?
Yeah, visible, but people are asking to go for slides.
Sorry,
It's in
I
percentage.
can't read. I'll
Yeah,
just check the chat box.
People want to. It's in the first slide.
Okay, okay, okay.
Yeah. Thank you.
Right. So typically, fast forward the 25 years, the value of 1 crore. So this is where the difference lies. If what is the value of 1 crore over 25 years? If it just grows at 7%, which is typically the risk-free return that we get on our investments, so that's around 5 crores. Whereas if the same investment would have fetched a return of around 12%, we would have been at 17 crores. So the gap is almost of around 12 crores. So that's the difference, which one should really understand, that it's not just about getting the investments done at a risk-free rate, right? Because risk-free returns are definitely available, but whether it is really doing any good to us, because on a post-tax basis, if you're going to eat away your capital, so by the time we retire, we may not be able to survive the for the next few years that we are going to live. So that's where one does not have a choice. It's the need of the day. One has to consider investing in assets which can give you reasonable return, beating inflation. So we say that, this is a study which was done by three pension fund managers in the US, and they wanted to determine what are the factors which determine the return that one can get from their investments. So as per their study, 92% of the return outcome that typically comes from any investment is due to asset allocation. 5% is due to security selection, and 2% is due to market timing. So we say that, typically, say, for example, if one is looking to buy a stock, say any company, one can choose between all the options. There are more than 5,000 companies that are available in the Indian stock market. You can choose a Infosys, you can choose a Wipro. So right among these two stocks, so you are not taking one decision, you are actually taking three decisions. One, you decide whether to buy Infosys or Wipro. So you choose, say, Infosys. That's the first decision that you take. You decide to buy it, say, today. You could have bought it today, you could have bought it yesterday, you could have bought it tomorrow. So that's the second decision. The third decision is the price at which you buy. You could have bought it at 100, you could have bought it at 150, you could have bought it at 200. So you're not, when you take any decision, typically you're not taking one decision, but you're taking three decisions. So it is very important that one does the right asset allocation, which can subsequently help you get the right return outcome on your investment. So, typically we've been hearing about these investor awarenesses where we've seen that क्या mutual fund सही है. So, और सही है तो कौन सा सही है? So typically, people look at historical returns while selecting the mutual fund, whether it is the right investment, and whether the mutual funds are giving the right, it is going to fetch the desired amount of returns. But, one has to really analyze a lot of factors before selecting the right mutual funds. We will come to that maybe in the later slides in a little more detail. Another very, very important point related to mutual funds is SIP, Systematic Investment Plan. I'm sure most of you may be doing it. If not, I would highly recommend all of you to start an SIP as soon as possible. What is SIP in a simple language is that, each one of us may be getting a salary in some or the other, from in either from our job or from our existing businesses. So it is simply investing a part of your savings that you get on a monthly basis into any asset. So, and we are talking here of mutual funds in particular, because that is the most convenient asset that is available today. It's just like a recurring deposit, which used to be there, and a traditional form of investment in the earlier days, where you are investing a fixed amount of money every month into an asset which can give you a reasonable return. So it takes care of the highs and the lows. When the market is high, you're still buying. When the market is low, you're buying. It ultimately averages out and you create a decent amount of money uh, ultimately from the investment that you do. And it is, of course, the most efficient tool today for wealth creation. So how does it typically work? Like I said, every month a specific amount is deducted on a desired date of your choice from the bank account, and it gets invested into the selected mutual fund schemes that one can choose. Units are allotted every time the money is invested based on the NAV, and of course, one can switch out and do the investments as and when required. So whenever you want to withdraw, you can withdraw that money too. So very important concept here. I'm sure you may have heard of this terminology, but not understood it to the extent required. That what is rupee cost averaging? So typically, when you do an SIP, say on a 12-month basis, and invest around 10,000 rupees per month, the NAV, which is the net asset value or the price at which you are buying the mutual fund units, will change depending on the market dynamics, right? But that market dynamics will help you whenever the markets make a high or a low in terms of adding the number of units that you get to your kitty, because of which the average cost per unit for an investor is typically lower. So if you see in this example, the person has invested around 1,20,000, and the average NAV at which, average price at which actually he has invested, which is the average NAV, is 20.33, but the actual cost for which we have got the desired number of units is lesser than that. So the average NAV is higher, but the cost per unit to an investor is lesser, because of which one should keep on investing on a regular basis in these mutual funds to get the maximum benefit at a lower cost. So that's a concept on rupee cost averaging. We would have heard about this story, the curious case of Chinese bamboo tree. So typically a bamboo tree in the initial few years does not grow. So first, suppose you take a tiny seed, plant it, you get the sampling. For the first year, nothing happens. You feel that as if the Chinese bamboo tree is dead. You need to water it, fertilize it. Still nothing happens. And but one has to continuously take care of it, water it on a regular basis, and to get the best result out of that bamboo tree growing. So the same experience happens with investments as far as equity markets are concerned. One has to let it grow. In the first 3-4 years of your investments, you may not realize as to what is really happening with the investments. It's only at the end of fourth or fifth year that you feel the benefit of the investing that you're doing, because that's when the compounding starts to work, and we will see in the slides to come ahead. So similar case in the bamboo tree, for the first 4 years it does not grow, and by the fifth year it grows up to 90 feet. So that's where the compounding and the investing benefit also happens. The initial years you are just investing, and sometimes you don't see that whether you are in the right asset or you're getting the right in return from your investments. But it's only the later part of the year that one really gets the benefit by investing also. So it's a game of patience. So like I said, initial years are very, very critical. So here we have an example: Ramesh, Mahesh, and Suresh. All three of them wanted to invest 5,000 rupees per month for 10 years till the age of 60. But Ramesh did a very interesting thing. He started very, very early. He started at the age of 25, whereas Mahesh and Suresh, they started at 30 and 35. So the benefit that Ramesh got by starting early at the age of 25, assuming he got a 12% return, the corpus that he created was almost 1.8 crores. whereas Mahesh and Suresh could only create 1 crore and 57 lakhs. So the point here we would like to emphasize is that one has to start early to get the maximum benefit out of their investments, which in our case Ramesh has done at the age of 25, and which is immensely benefited. And you can see the gap that's there between Ramesh and Suresh. So in a gap of 10 years, we are almost talking of one third, 60 versus 180. 60 lakhs versus 1 crore 80 lakhs. So that's the difference in a gap of starting late by 10 years created to the individual. So the best time or the right time is when you have the money, or it is today.
Sure.
Yes, please.
Yes, just actually slides are not moving. Attendees are asking, can you please go?
I don't know what is the reason.
Okay.
Should I put it on this way? Is it visible now?
So this is the Ramesh Suresh slide, right? Is this one?
So I've moved on from that. I'm
Okay.
on this equity view preamble. Is
Okay.
this visible, or should
Yes,
I
it's
stop
visible now.
sharing and put it on? Should I share it again?
No, this is visible. Equity
It's
preamble.
okay. Okay.
Yeah.
So this is a view on equity markets as to how they have behaved in each of the years. So right, we have the data right from the year 2000 till 2024. Typically, investors feel that equity market is risky. हमें equity market में invest नहीं करना है because it is gamble. It is very risky. People don't make returns. But if you look at this data, for the last 24 years, Nifty has actually grown at 11.5%, which in our opinion is, by far a very reasonable number. And we are talking of the various instances, including global financial crisis, which has happened in spite of an event like COVID. In spite of that, if you look on a calendar year basis, for the last 24 years, we have grown at 11.5%. So, there are instances where 20% instances where calendar year basis, there can be negative returns. But the point is that if one stays invested for a longer tenure, definitely one can have a reasonable returns from the investment. It's just about having the right amount of patience. One will definitely make a reasonable money through the equity markets. What are the factors generally which impact the equity market returns? So we typically classify into three buckets. One is short term, second being medium term, third being long term. So short term being anything between 1 to 3 months. So in the current case, we have elections around the corner, a lot of discussions happening as to what is going to be the probable outcome. So these are the situations which are generally which are going to affect in the short term, right? Because it's not that the elections are happening for the first time. For the last 24 years, there have been various instances where elections have happened, government majority was not there, etc. So even in such instances, the markets continue to be there because the short term events or situations are something which is not in our control, right? And they may impact more. But what one needs to look at is, and one should not consider investing if you are investing for short term, because ultimately the money, because we don't know what is going to be the probable outcome of election, right? So typically whatever be the outcome, if your horizon is little longer, one can make a reasonable return. So the factors which affect, like I said, short term, there can be various events, news, war, etc., which affect in the short term. Medium term, 1 to 3 years, the factors which are important, which will determine whether you will make the return or not, are typically corporate earnings, valuations, which play a very, very major role. And long term, beyond 3 years, which we typically recommend that if somebody is participating in equity markets, should have a horizon of at least 3 years plus, because anything less than that, there are chances that you may or may not make return. But if you give your investments at least a time duration of 3 years, there are chances that very high chances that one will make reasonable returns out of equity investments. So duration is very critical while choosing equity market, entering equity market. So typically what happens that we think sometime about things which matter and things you can control. So of course elections is something which is important to us because that determines how the economy will grow, but it is something which we can't control, right? We can't control the outcome of what is the election result going to be. So we have to take a reasonable call that, okay, irrespective of whichever government comes into picture and by whatever number, how should we plan our investments and what should be our focus? So that is something which can help us go a long way as far as decision making is concerned into the equity markets. So there are various scenarios like we just discussed, situations which are controllable, which are not controllable. So rather than thinking of कि election का outcome क्या होगा, rather let us think about how much we earn, how much do we save out of it, and how much can we invest. So typically Indians are very good savers, but they are not very good investors. The simple reason for that is typically the kind of money which is lying in bank fixed deposits is very high, and it is one of the most tax inefficient form of investments, but still people prefer to park the money in a bank fixed deposit. So similarly, if we are talking of career, whether we are earning enough for ourselves or we want to make more out of our career, that is a situation which is controllable, and maybe that can affect your investing pattern. Similarly, education, debt, asset allocation, etc. are the things, something which we can control. But as far as expecting a certain outcome of the stock market return is not dependent on in our hands, right? Because the company as to what kind of earnings it is going to generate is basis our research, but the returns may or may not be directly correlated with that in the short term. Of course, in the long term, it will ultimately depend whether the company is making enough money to get the reflection on the stock price. Similarly, inflation, real estate prices, these are the other situations. The tax, if the government, like until few years back, we didn't have tax on dividend. But when the dividend taxation was announced, that is something which is beyond our control. That does not mean that we stopped investing into shares, right? We still invest in shares and we get dividend and we pay tax on that. So we need to really identify what are the situations which is controllable, and we should focus on that. See, this is another very important slide which I would like you all to focus on. So typically, this is the data for, we have taken 20-year data to check what is the times when investors have made money or may not have made money. So if investor is investing for only 1 year, so we are talking of 1 year rolling returns, we have taken a 20-year data. So the point here we are trying to say is that how we can reduce the volatility, because investors say that अरे मैंने तो 1 साल पहले पैसा डाला था और मेरा पैसा से 20% डाउन है, 100 रुपए का 80 रुपए हो गया. So the point where we are trying to say is that if you are investing only for 1 year, there are chances that 1 out of 4 times you may lose money. That is what data, this is actual data which we are showing. If the same thing, if instead of 1 year, the person would have say invested for 3 years, the chances that a person would have lost money, there would be only 1 out of 9 times that investors would have lost money. So the probability that you lose money even by investing in equity markets gets reduced to the extent, where 1 out of 9 times you may lose money. The return becomes more stable and consistent. And if the same investor, instead of 1 year and 3 year, had he invested for 10 years, then there is a possibility that at least he would 97%. So every 100 investors, 97 of them would have at least made 15% and never a loss. So, we invest in, say, an investment like a gold, and we say that yaar gold to kabhi girta hi nahi hai. But the problem with that is that we don't even look at the prices of gold on a daily basis or a weekly or a monthly basis. We just buy and forget about it. So same thing applies as far as equity markets is concerned. If one can stay invested for longer term, one can definitely make very good reasonable returns out of the investment. So, this is a common question we typically get, that when should we invest into the equity markets, because it's already, say, currently also Nifty is close to an all-time high. Indian markets are close to an all-time high. This is a data which suggests that even if you invest at peak levels or at a certain time, say a beginning of every month in Nifty for 5 years, 10 years, 15 years, 25 years, the gap between the returns that you would have made, even if you would have invested at the peaks, is very, very minimal. So we can see that if you increase of course, in the short term, say a 5-year tenure, you may see a gap of around 2%. But if the same tenure is increased to 10 years, 15 years, the gap keeps reducing, and it does not matter when you invest it. So instead of thinking that whether we should worry about investing, whether market is at peak, should we invest, should we withdraw the money, should we do some rebalancing, etc. So that is a very, very futile exercise if the horizon is little longer, and it does not really add too much value to our investments going by that. Insurance planning is something which is very, very important and is a strong base to any family, because typically what we have seen is that people don't have either the traditional products, and even if they don't have the traditional products, they don't even have a term insurance and health insurance. I would say that the first thing that one should do when they get a salary or when they start earning is to have an adequate term insurance and a health insurance, because there are families who've gone bankrupt because of the health expenses that have arisen in their families, and because of which they did not have a health insurance, and because of which they suffered a lot. So typically health insurance and term insurance and an adequate amount of health insurance and term insurance is typically we would suggest all individuals and all families to have with them. Of course, there is a huge potential because India as a market is still very nascent, and there is a great potential for India to grow as far as insurance is concerned. Together we need to ensure that maximum people have an adequate health insurance and term insurance. So the key rules of investing and compounding is to start early. Like we saw the example of Ramesh, Mahesh, and Suresh. The one who started early definitely gets an advantage. The second most important thing is to have the discipline to invest on a regular basis, because what happens is that अरे जब market गिरेगा तब मैं invest करूंगा. But the problem is that market कब गिरेगा, कितना गिरेगा, we don't know. So the idea is to have a plan in place which can bring in discipline, and that discipline can be used to invest. And then the idea is to stay invested, wait patiently till we don't have a need to withdraw that money, and that's the mantra which can be used for helping and growing our money and compound the money, right? Discipline, like I said, is very, very important. This is a classic example what Bruce Lee had said, that I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So discipline is very, very important in all walks of life. Albert Einstein says that compounding is the eighth wonder of the world. And we will have an interesting example where I would like some inputs from you all to see, understand the power of compounding. So compound interest is the eighth wonder of the world, and the one who understands it earns it, and he who doesn't pays for it. So the early we understand the benefit of compounding, the better we can make from our investments. So this is one, illustrative comparison on compounding. So suppose, like we said, if one invests say 10,000 rupees per month in a bank fixed deposit for 30 years, one would have got around 1 crore 7 lakhs. But the same 10,000 rupees per month, say, would have fetched around 15% return. So instead of 1 crore 7 lakhs, one would have made 5 crore 63 lakhs. So almost 5 times the money, though the return percentage, annualized return that you would have got on the investment is not 5 times, but the corpus that you create is definitely more than 5 times. So that's the real benefit of compounding. uh, I would like all of you to participate by putting it in the chat box. If you were given a choice, and have you really understood compounding? Option A, if I give you 1 rupee uh, at one place, where you invest 1 rupee 1 point of time and you get 1 crore back in 30 days. That's one option that's available to you. Or you double your 1 rupee every day for the next 30 days. One was to give you this choice. What would have one opted for? If I can have few answers in the chat box, whether you would have opted for option A or option B. The chat box is enabled, right, Akash?
Yes, it's enabled. It's enabled. Yeah.
Or in the Q&A box.
Option B by Mr. Karthik Sivarat, sir. We got one answer.
Lovely. I would request other participants also to post in their option. So we are talking here, if one gives you 1 rupee and instead of that you get 1 crore in 30 days, and the option B being double your money 1 rupee every day for 30 days, what would you choose? Okay, so let's move on and see what is the outcome that we get.
Yes.
So here we can see that 1 rupee invested for 1 day. Of course, option A is clear, so we don't need to explain that in detail, because 1 rupee invested, you get 1 crore in 30 days. Whereas in option B, you're doubling your money every day, and in 15 days time period, it would reach to around 16,384. So option B does not sound very interesting, but why have people chosen for that? Uh, in the Let's extend it, because we just reached 15 days. If we extend it to 20 days, the corpus would have been at around 5.24 lakhs. Still, I think option A sounded much better, where we would have got 1 crore. Here we are close to only 5 lakhs. But if we move forward and look at the time period between 20 to 30 days, the kind of creation and the amount that one would have got in option B is 53 crores 68 lakh 70,912. So that's the difference, that one would have created in the initial 15 days, initial 20 days. We didn't really see much benefit in option B. It's only the later part, maybe the last 5 days, which had the maximum impact. Because if you look till 24th day, we were at 84 lakhs, whereas in the last 5 to 6 days, that amount is grown to almost 54 crores, and that's the real benefit of compounding, which one can make if invested right. The next is, of course, this is again an actual example of 1 crore invested in 1990. What would be the value today in various investment classes? So typically an LIC endowment would have given at 7% 5 crore. Fixed deposits would have given 7 crores. Gold would have given 8 crores. Typically a real estate property would have grown at around 12-13%, whereas some of these mutual funds, the value of 1 crore would have been close to 250, 300 crores. So that's the kind of returns that equity markets have delivered, and that's the real wealth creation that we are talking of, right? So one has to be really careful as to what investment options they are choosing for themselves on their hard-earned savings. So we can see the difference that, between say a gold and real estate, the gap is almost of 2x. Between the real estate and Sensex, 2x, whereas Sensex and typical mutual fund options that are available, which were launched at those points of time, there, one would have made almost 8x more than what one would have otherwise made in Sensex. It's we have all heard at some point of time about the great Sir Mr. Warren Buffett, and we can see that he himself said that it's never too late to build a fortune, and the way that he has created his fortunes has actually been in the last few years of his investing career. If you look at the period until 60, he did not have the right amount of wealth for himself, in spite of being what he is today. So he started at the age of 11 and still felt that it was too late for him to start. He wished that he started a little more earlier. And 90% of his wealth was after the age of 65. So compounding really takes some time to start to put to work, but one has to give it that desired time to get the best results. Retirement planning is something which is very, very dear to everyone, because typically in India, we don't have really very, very good options as far as retirement. So one has to consider and plan for their own retirement. So it is a very, very crucial goal for most individuals. And the new age of retirement. So people typically used to retire early at 60, but gone are those days where people would retire at 60, and people typically want to retire much early these days and have a comfortable living for the next few years. So one needs to have enough corpus creation for the purpose of retirement, so that you can survive along with your family for the next few years of your life. So estate planning, Sujata had conducted a great webinar where she had emphasized on having a will, which one should have, because so that one can get the assets to the desired nominee, whom they would want to transfer the assets in their absence. So one should really have the right estate planning, the desired nominations in various bank accounts, various assets, so that the desired people get their assets back. I think with these, we can also, of course, do a complimentary review of any of your existing investments. We have a very large team, a specialized team who can analyze your existing MF investments, direct stock investments, even if PMS for that matter, insurance policies. Also, we do a very, very thorough and detailed review. If any of you are holding any of these assets and would want to understand whether you are doing the right thing, we could do a very, very detailed review on the following parameters on return, risk, in the right asset allocation, etc., and give you a insight as to whether you're doing the right thing. So, success is all dependent on your effort. If you make that right effort, you will definitely get the best results, and we are more than happy to help you. If there is any Q&A, please feel free to write in the chat box, and we'll be more than happy to answer.
Thank you, Rishabh. Thank you so much. It was really insightful. Giving us example about option A, option B. You don't have the example. It's really
Yes.
helpful.
So if you have any questions, we can take it.
Sriramurthy's questions. Okay, fine. If you don't have any other questions, let them come to our email later.
Certainly.
Certainly, right? Yeah.
I think Karthik is asking a question. Do we provide wealth planning consultations? Of course, Karthik, I think you could reach out to Avkash or Sujata, and we could set up a mutually available convenient time, and we could have a larger discussion at length.
For sure. Of course. Fine then. So thank you so much, guys, for taking some. I want to thank you to all the participants who give the time on Saturday morning. And thank you, Rishabh, for your insightful session presentation on investment. Sure, all the attendees have gained some basic knowledge about what they should do and with the example certainly. And any questions and doubts can also be sent to our email ID. That will be
Certainly.
certainly we will like to help you out. Whether you're looking for any spoken wealth, safeguards and anything, if you like, certainly like to help. If you're interested in learning about more about financial planning, your financial goals, you are here to assist. You can hear me, right? And we are here to achieve your
Yeah,
financial
we
goals
can,
as
we
well.
can.
And sure, don't hesitate to give contact us. Thank you, guys. Thank you all. And have a very
Thank
good
you
day.
all. Thank you,
Thank
everyone.
you. Thank you, everyone. Thank you. Thank you.